Ever pondered over what the appropriate buying ratio of options as a hedge for futures positions among derivative products is? Well, today we unravel the mystery surrounding this question. First, it's important to understand what options and futures are. Options are financial instruments that give the holder the right, but not the obligation, to buy or sell an asset at a specified price on or before a certain date. Futures, on the other hand, are contractual agreements to buy or sell a particular asset or commodity at a predetermined price at a specific time in the future. Now, when it comes to using options as a hedge for futures, the buying ratio isn't a one-size-fits-all concept. It's a dynamic figure that depends on the individual's risk tolerance, market volatility, and the specific characteristics of the underlying asset or commodity. The first step in determining the appropriate buying ratio involves identifying the risk exposure of the futures position. This involves a thorough analysis of the underlying asset, market conditions, and the potential for price fluctuations. Next, consider the price of the options. The cost of options can vary widely depending on factors such as the volatility of the underlying asset and the time until expiration. It's important to factor in these costs when determining the appropriate buying ratio. The third step involves determining the delta of the options. The delta is a measure of how much the price of an option is expected to change for a one-unit change in the price of the underlying asset. A higher delta means the option's price is more sensitive to changes in the price of the underlying asset. Lastly, consider the correlation between the futures and options positions. If the positions are highly correlated, a lower buying ratio may be appropriate. Conversely, if the positions are not highly correlated, a higher buying ratio may be needed to adequately hedge the futures position. To summarize, determining the appropriate buying ratio of options as a hedge for futures positions involves a careful analysis of risk exposure, option costs, option deltas, and the correlation between the futures and options positions. It's a delicate balancing act that requires a keen understanding of the intricacies of derivative products and the dynamics of the financial markets. Remember, hedging is not about eliminating risk, but rather about managing it. The optimal buying ratio can help in minimizing potential losses while still allowing for potential gains. It's a strategic tool that, when used correctly, can enhance the overall performance of a portfolio. So the next time you find yourself pondering over the appropriate buying ratio of options as a hedge for futures positions, remember these steps. And always remember, it's not just about the numbers. It's about understanding the market dynamics and making informed decisions.